about that.
Welcome to Real Estate Focus. Our topic is updates of the economy and the real estate market. With me here today is Mullin. Mike is the financial advisor from MEM Capital Advisors, and he's here today to share with us about the economy and also the real estate market. Thank you, Mike, for being here.
Thanks, Calvin.
Welcome.
All right.
So the first question is, what is the outlook of the market and also the economy in 2015?
Well, I mean, as you've probably read over the past couple of years, I mean, the market has done surprisingly well, given that a lot of people have kind of dealt this economy. But the economy itself has done okay as well. There hasn't been, as big problems that have caused it to to sort of retract it all. It's been slow and steady, and a lot of times you see that after a financial crisis, which is what we saw in 2008. Some people claim similarities back to the early 90s when we had the financial crisis there as well with the savings and loan banks. You can kind of see that coming out of that, just a long, steady let's get everything back under control and growth from there. So the growth has actually been there, and we'll see some graphs that will actually show that as well. So overall, the economy is doing well, the market's doing well, but there's definitely some doubt out there as well.
Right, and the housing market is doing very well as well, because as you might know, housing market right now is a seller's market, and there are multiple biddings everywhere. And with low inventories and high in demand of housing, it's a strong seller's market. However, it's still a good time to buy because low interest rates and also affordable monthly mortgages as well. So yeah. And let's show some graph, if you will, and talk about the economy as a whole, and I think this can be helpful for a lot of consumers, if you will.
Okay, yeah, let's do that. The as you can see on this one, GDP, the gray areas going vertically are recessionary periods, and as you can see, there's a steady drop off in GDP growth, and this is year over year percent growth. Now, what we've seen over the past 5 years is really not robust. We're not talking 3 to 4%, but 2.5% growth. Historically, over a 50-year time period, GDP has averaged 3.2%. Over a 25-year time period, it's averaged 2.5%. So at 2.5% right now, we're at that range, and so that's decent enough growth for the economy to expand. And you're right, housing is definitely a contributor there. Housing can represent anywhere from 15 to 18% of overall GDP when you count in home buying, rents, upgrading your house, things like that. So housing is very important, and the rebound in housing has certainly given a little tailwind to it.
So the housing market makes up 25% of the economy, right?
Yeah, that's a little more rich than I just said, but yeah, but you could go that far.
Yeah. Okay.
It depends on the data you're looking at. The data I read is from the the Bureau of Labor, from the bureau that looks after GDP, calculates GDP, and 18%. But yeah, you could go higher if you want.
Day, right?
Absolutely, but you're right about things like how houses not being on the market very long. Home prices are high, and we'll see some of that in some of the later graphs.
Right. So the next one.
Yeah, this is the Conference Board and the Federal Reserve do leading indicators. So in a way, like everyone gets concerned about, well, the economy is going to crash next year or something like that, and they do a lot of the work for us as far as getting certain indicators that really give a good grasp of where the economy is headed.
Yeah. Right.
And this is also a percent change year over year, and this is a 6-month rate of change. And what you can see with the vertical lines again being recessionary periods is that whenever the the year-over-year change dips to negative, a consistent negative. Sometimes it has a little blip here and there, but if it consistently goes negative, it precedes a recession, and anywhere from 6 months to a year. So there's a little heads up, so to say, if you're paying attention to the data. So that's always a good graph to monitor. And right now you can see that it's still pretty robust, and that's good for at least the interim, whether it be a year to 3 years.
So the green colors, I mean, which means a positive.
Yes.
Uptake.
And the green means is the leading indicators are growing, and and some of these can be measures of housing, measure of unemployment, measures of industrial growth and things like that. So that's all factored in there.
Right. And the next one, if we can just continue to talk about all the graphs.
Well, sure. This is industrial growth, and that's all the manufacturing that takes place to build build goods and services. It's considered robust when it's above 50. It's more of a static scale. So right now the index is above 50, and it's been that way, almost throughout this recent economic cycle.
6-7 years, right? Roughly.
Yeah. And I mean, sometimes occasionally it's very cyclical and it does dip below and go back up. But it also has very deep negative periods during the recessions. But right now that also industrial growth is showing positive sign.
That's great news. So the next one.
Corporate profits, there also can be a tailwind to GDP growth. They can be anywhere from 10 to 15% of GDP growth, and it's been a robust period for businesses, for companies, for their profitability. It's starting to maybe taper off a little bit. But still, it's robust enough where it's helping out GDP growth.
It looks like 2010, between 2010 and 2015, I mean, the graph continued uptick, so which means that positive.
Yeah, companies haven't really had to pay people too much. Wages haven't really gone skyrocket, and neither has employment growth. They've been able to cut costs and things like that, so they've been able to keep profits up.
Great. And the next one.
People are always concerned about employment, and employment is something that helps also drive the housing market as well. People have jobs, they have extra money, they have disposable income, they can buy things for their house, they can buy houses, they can rent houses. So payrolls themselves have been increasing at a decent enough rate. It was definitely problematic and definitely systemic and structural. There still are a number of unemployed that have just sort of left the labor force. One of the biggest issues has been the labor force participation rate, which is right now at the lowest it's been since the late 70s, and 62 or 63% of the population the civilian labor labor force is currently working. It needs to be higher.
Yeah.
And hopefully that change. Some things will happen that will make it higher. So we still have a job problem, even though the unemployment rate has dipped below 6%, which is great. But it's kind of sneaky because a lot of people have just outright left the labor force entirely.
Because of low paid jobs they couldn't get, or
it's a bunch of things. I mean, it's baby boomers who are nearing retirement who decide to retire. It's people staying in school longer or going back to school to get an extra degree. It's people just sort of giving up. Young millennials just deciding to live with their parents for a little while until they can go out and afford a home.
Save more.
And all those things contribute to it. So if they can start to trend in the other direction, and we can be more productive as an economy, that'll help a lot of that.
But it's going to take years.
Oh yeah, it's definitely years, a year, decade sort of thing.
With increased tuitions and then costs pretty much on everything, housing, rents and stuff like that. So yeah, it has a big effect on the economy and also on a lot of young generations, if you will, especially new graduates.
Yeah. Well, a lot of people haven't seen a good economy. I mean, this is kind of their first really good economy for younger people. And before that, in the past decade, we saw 2 recessions, which is not normal. And now people are starting to think, well, this economic cycle is getting a little tired because it's lasted 6 years. And they really shouldn't be thinking that way, because that's not the case. It can last longer. Both economic cycles can go. Especially coming out of a financial crisis like we saw, such a deep one, 10 years wouldn't be out of the question. So, if we can look into the horizon and see, and see the, what's ahead, I think, the next 2 to 3 years could still be very good for the economy. so people shouldn't really be in a rush to have a recession. Let's put it that way.
Yeah, it's good to know. Yeah. So the longer the better, no question about it. So the next graph, if you will.
Well, now we're getting into really housing and its importance into the economy and the GDP, and it was kind of an unprecedented run-up we saw in the in the 2000s where housing just took off and people were building homes and flipping homes and all that sort of stuff, and it was actually really bad because it was kind of fabricated and unneeded. Let's put it that way. The demand really wasn't there to justify the supply. And now we've seen, we saw such a huge pullback in construction growth has completely stopped. Homes were underwater and all that sort of stuff. So there was a huge retraction. It's taken years so far to get any sort of semblance of normalcy.
Back to normal.
Back to normal. And we're not even really there yet. I mean, we're still at unprecedented lows in home sales, construction lows, home starts, permits for construction and things like that, are still at historical lows, but they're getting a little bit better. It's starting to get more like halfway back to normal, and that's good. And the expectations are that that's really going to continue because now they're starting to get to a point where there's not enough homes, living as you probably see. People are, fighting over buying the existing homes because there's not any new ones. And that's a good problem to have because that means construction down the road will continue. Construction will help, the economy. Will put some other people back to work and continue with jobs, all that sort of thing. So it's definitely needed.
Yeah, as long as the Fed doesn't raise the interest rate too crazy, I think that people are still, wanting to buy and own within this couple of years, along with low interest rates, if you will.
Yes.
And low interest rates, even though the prices a little bit higher. However, their mortgage payment will make a huge difference in terms of 1% percentage increase or 2% increase. And so, hopefully the interest rate will stay very steady, so that number one, it will help the economy and also improve the housing market. So with that being said, so what is the next graph that you want to talk about?
Well, gets along with what you're talking about prices. And this is actually prices specifically in the Northeast, so we can look at that regionally. And it kind of goes across the board nationally as well. But, we saw a steep drop-off in the average home price. We saw it sort of flatten for a little while. And now we've really seen it to start to accelerate and pick up. Some of that's because of lack of supply and more demand than supply. And also low interest rates. People can afford the houses. They're able to get loans now. They're able to, they have the cash to go down and put the down payment down and buy it, which is good, but then bad too, because as you said, the prices might be a little artificial right now, and any big drastic movement in rates can affect a lot of what's going on. I'm sure, that's another thing that people are clamoring, like, oh, we need interest rates to rise, and we do and we don't. Like you do because that means that there's the economy is getting back on track. The bad part is that then if there's an accelerated rate increase, like too much too fast, it could slow down everything, including the home buying. So a nice gradual approach and that's sort of what the Fed has hinted at that they're going to do. Maybe you could see 25 basis points in September, another 25 in December. You might not, though. I wouldn't be surprised. I mean, I think 80 to 90% of people polled said that they expect that. And then next year, by the end of 2016, they're saying 1.5 basis points on the Fed funds rate, which can affect the 10-year. So we shall see. But it's not. I wouldn't be in a rush for that either.
Well, everything contingent upon the economy, the job market, and also the inflation and deflation, if you will.
And that's kind of an important part that the Fed watches that we kind of ignore is inflation and deflation. And right now, their biggest fear, why they've kept rates low so long, has been deflation, which means that the monetary base is actually contracting, and it can stifle growth. It can stifle the economy. So they want to see a little bit of inflation. Like 1% to 2%. It would be nice. And it sounds weird to say that, but that's more of a healthy economy. And when they get worried about it, that's when they start ramping up rates, and that means it's sort of the end of the economic cycle. So,
right.
So the fact that they've taken this long has been actually probably the right thing to do.
Yep.
And a lot of people have benefited because they've been able to refinance. I mean, what a curveball last year when everyone expected rates to go up and they actually, went down again, and people were able to refinance again, or for the first time, and then and also be able to get mortgages. And now the mortgage rates are creeping back above 4%. But that's still ridiculously low.
It is.
Eventually, I know the National Association of Realtors expects 5% by the end of 2016, 6% by the end of 2017, and that's probably about as high as they would go unless things get crazy. So 4% is still pretty good mortgage rate. I wouldn't wait around for it to go under 4 again. Let's put it that way.
And then, unless another recession hits, right?
unless something hits, and there still could be could be a pullback, but it's more of a wishful pullback than a needed pullback.
Right. So and it depends on who's going to be the new president, and whether the Republican is going to be in the White House or Democrat. So
political factors.
A lot of factors involved, and I think the next graph is about
that's the inflation, and that's kind of what we're getting at, how they're worried about deflation. And you can see, I mean, the big sharp drop off recently has been really because of oil. Oil prices last year, and oil is a big part of everything that we do, whether it's companies buying prices or consumer prices, is factored in there. So we saw a year-over-year negative blip. It could be an aberration. We'll see how the next couple quarters what happens, but before that we were in that 1% to 2% range, which was fine, and that's what the Fed was looking for. They needed a little bit more, and they were going to definitely raise rates this year. That's why I think it might not be a sure bet for them to go 25 in September and December. Maybe one in December. I don't know, but it's definitely their call on that one. Anything can happen. They're reading the tea leaves a little bit better than we are.
Right. Yeah. So the next one is
producers. Producers. So things that a company needs to buy materials to build things, and year over year that also has dropped off, and a lot of that can be attributed to the drop in oil and other materials, commodities. So maybe if that gets back up to 1% to 2%, well, that's another wait and see.
I see. And so with all that we talk about, so what is the outlook for U.S. business?
Positive, I hope. Meaning that as long as if businesses can sort of embrace the economy right now instead of being a little bit scared to build things and take chances, because one of the biggest things that's not being factored into the economic growth right now is capital expenditures, meaning that companies aren't going out of their way to build new factories and to build goods to sell. They're not making investments in their own firms. Let's put it that way. They're doing things like to keep their profitability up by like buying back stock or issuing dividends to shareholders. They need to the businesses need to take an investment in themselves as well and in the economy. That would be another big boost, and would really help out extend sort of this economic cycle. And it should happen. So I think businesses are starting to feel a little bit more comfortable. They've been starting to do it in the past 6 months. The outlook for the next 6 to 12 is actually the same. They're actually looking at hiring. Businesses are looking more positive on hiring, more positive on spending money than they have been during this whole entire economic cycle so far. So I guess that's the outlook on business.
Yeah, and so based on your observation, which industries have the most improvements that
good question
so far?
Yeah, good question. Residential construction still has a long way to go. I mean, and that goes to the part where we're talking about there aren't enough places to live. Their housing supply has come down enough where they need to build more. And beyond that is actually the infrastructure that goes to where they can build. I know I heard that some building, residential construction firms nationally, I'm talking maybe as much here, but they've got the land, but they don't have the infrastructure, which means like the plumbing in the ground, the electrical, all that sort of stuff. So right there lies another thing, and that's the infrastructure of the municipalities, and the firms that do construction on bridges and things like. I mean, that's a whole other thing. Is that in the United States, a lot of our infrastructure is getting very dated and old and needs to be upgraded.
they all have to do with budget and also politics involved as well.
A lot of politics, ton of politics.
So therefore, if any of those get caught in the middle, things will slow down. So it could be a lot of factors like costs. I mean, that's the first thing that comes into place, and also the politicians. In each town is different. So therefore, and
bigger than we know.
Yeah, that's right. That's right. So that's good to know. And in terms of housing, I mean, the outlook so far is pretty good. However, based on what we talk about, I mean, we still have a long way to go. Even though things are starting to improve and with a strong housing market and stuff like that, but I think that's still a long way to go.
Yes.
Yeah.
Yep.
Yeah. So, what about the mortgage rates? I mean, do you foresee that the rates continue to uptick until 2016, based on what you talk about?
Yeah, and I mean, another graph shows the steady fall in mortgage rates throughout the past few decades, right. And so that's when we say we're at historical lows, and and I wouldn't wait around for it to get for mortgages to stay below 4, just because the expectation is that rates will rise. We said that last year and the year before actually as well, and they sort of haven't. But I think that when things start to pick up economically and the Fed starts to worry about inflation, less about unemployment and things like that, that rates, they will start doing those little gradual 25% basis points here, 25 basis points here. So that, when mortgage rates are expected to be above 5% at the end of next year, 6% at the end of the year after into 2017. So that's what the professionals say. I think I wouldn't be surprised if it took a little bit longer too, just because of the fear of deflation.
Right, right. And if it were to do, the interest rate were to go up to 6% or 6.5%, it's very similar to 10 years ago, 2005. I mean, the rates I remember that went up to 6%, 6.5%.
We would have loved a 6% mortgage back
10 years ago, right?
10 years ago.
So right now people are spoiled because the rates are so low.
It's a borrowing cost. I mean, you're borrowing money from an institution to make a purchase on an asset.
That's right.
And if someone's going to give you a loan, a long-term loan, for 20 to 30 years at 4%, and you have the affordability and the ability to do it, that can be a pretty good deal with the right decision if you're buying the right property. So that's not that bad. If it was like 8 to 10%, different story. But it's not, and it's probably not going to be for a few years. So I would say 4 to 5%. It's probably
going to be a different story, right? When it gets up to 8, 9%. I mean,
hopefully it won't get there. I don't think it. I shouldn't say that, but I don't think it will. Not within the next 5 years.
Yeah, it's gonna take a little while before it gets up to 8 or 9%. But we'll see. So, what is holding the economy back? I mean, based on the job market, is that based on the what's it?
Yeah.
Is it CPAC? Is that CAPEX?
Capital expenditures.
Yeah,
CapEx.
right. Okay.
Yep.
So
I would say those two things, and then a third. I would say so first. The job market. As we talked about, there's a lot of people who have just left the labor force. If they can, if the economy really starts clicking and can draw people more back in, the whole country can become more productive. The economy can become more productive. That's good for everybody. Capital expenditures, businesses investing in themselves. That's another good thing. And the last thing really is internationally, which we haven't touched on yet, which is the U.S. has been doing okay, but the rest of the world really kind of hasn't.
Yeah, that's right.
And whether it's China going through more of a contracting growth period, which they were sort of later than we were. When they come out of that can help. Europe has just been a mess. But there are signs that when things get just a little bit better, it really helps out and it kind of gives everyone a good feeling. So I think further on down the line, the international aspect of it will actually help extend this economic cycle a little bit further.
Right. And basically, like you just mentioned, if the economies were to get a little bit better, I mean, around the world, I mean, there will be a lot of sensitivities for people to inject spendings and also confidence into the economy. So I think at this point, even though the economy has improved, however, any good news or continue to improve on different sectors will continue to help the economy in the world of
Yep,
course.
globally, domestically.
Yeah, that's right.
Yes.
Well, Mike, I want to thank you for sharing. Thank you for being here.
You're welcome.
Yeah. So, with all that being said, the real estate market and mortgage rates as a whole depends on the health and the growth of the economy, along with the job market. In 2005, has impact the creation of low supplies or inventories and high demand in housing. However, this is the seller's market and a strong housing market, but with low interest rates and the affordable prices as well, that factor will give a lot of home buyers low mortgage interest rates and also low mortgage payments. I want to thank you for being part of the show. See you next time.